There's a story of consumer banking vs investment banking. Do you see any reason in the fourth quarter why that trend is going to change?
Well, I think the trend that we're seeing already is that the investment banking side is starting to slow down again. So the whole investment banking side and trading side and fixed income trading in particular did phenomenally well at the end of Q1 and throughout Q2. And those were real blowout quarters for these banks in terms of trading and investment banking. What we saw in the third quarter was that slowing down a bit. So trading was still way up compared to last year, but down compared to last quarter. So we're seeing that sort of stop, the defiance of gravity that we've seen in the trading revenues is sort of starting to ebb away, and gradually we're getting back to a more normal level. The consumer side banking, as you pointed out, has been a bit soft, but not as soft as you might expect given this environment. You quite rightly point out that the market looked at JP Morgan's earnings with a big yawn, basically, and said, so what are you going to give us next? But I think there's some distrust of it in terms of the accounting, because so much of it is basically these credit reserves that they built up over the course of the past 2 quarters, massive reserves that is set aside, which are somewhat subjective in terms of how they calculate it and how they put them aside. It seemed even at the time that they were sort of over-reserving, and now they're correcting that, and so the earnings look that much better. So if you look at simply the return on equity, yes, we're back to pre-COVID levels, but there's been some playing around with the accounts a bit, well within what's allowed, but there is some subjectivity in that. And I think the markets are distrustful of that a bit. The accounts don't really mean as much as you might think they do.
Octavio, as we came into this, everybody said, focus on the provisioning, because that will let us understand what asset quality is likely to be going forward. What did you make of the provisioning that was done here?
Well, JP Morgan's provisioning has come way down. So I think, again, it points to an over-provisioning and over-reserving that they did in the past. And I think that makes perfect sense. If you're the CFO or the CFO of a large bank, and you're looking at an environment where the economy looks like it's crumbling in front of you, yet your trading arm is generating phenomenal profits and the bank is going to look wildly profitable, you don't want that for a variety of reasons. First of all, you want to set some money aside for a rainy day that you can draw that down those reserves then afterwards. But also, you don't want the public to think that you're sort of the evil bank making wild profits while the rest of the economy is suffering terribly. So for a variety of reasons, they over-reserved and now they're sort of unwinding that. So that's what I would say there. Citibank's reserves are still relatively high, so they're sort of closer to normality, but JP Morgan's have come way down. But they simply over-reserved. They've set aside too much money and they recognize that, and now they're drawing that down to make the profits look better.